Despite projections of 8% economic growth this year, China is floundering to cane down numerous economic challenges of its own making. The debt distresses of the country's biggest property developers, led by China Evergrande, which owes more than $300 billion, are threatening to crash the property market. New home deals are down by a fifth in China. But how will this affect the global economy? Keep watching today's video to find out. But before that, make sure you have pressed that red subscribe button along with that tiny bell icon to get updated every time we post new videos. Let's get started. Evergrande Group is the world's most indebted real estate developer with dues worth over $300 billion, including bank loans, short-term borrowings, and supplier credit, among others. The amount is equivalent to 2% of China's GDP and presumably one of the biggest debt piles in the world. It was once China's top dealing property developer, but tightening of lending rules by the country has made existence difficult for the debt-laden company. This is in stark contrast with its position a few years ago, when it was part of the elite Fortune 500 companies. There are fears now that the collapse of the company could have serious impact on the country and the world, given the fact that China is the second largest economy in the world. Worried investors have even named the crisis as China's very own Lehman Brothers moment. While global brokerages have downplayed the threat of Evergrande's crisis, it could pose serious pitfalls to China's property market and economic instructions. A spillover effect, therefore, cannot be ruled out. Stock requests around the world have been jittery as enterprises keep growing over the possibility of massive defaults by one of the biggest Chinese real estate investors, Evergrande Group. Rising inflation continues, and the Federal Reserve suggested it'll soon announce that it'll begin to buy fewer bonds. This so-called tapering, while not as important as raising interest rates, does signal that the Fed is inching away from its emergency policy of pumping in a lot of easy money to help the economy recover from the COVID fallout. And then there's Washington. Not only is Congress mooting a hotly contested $3.5 trillion social program bill in addition to the $1 trillion structure plans, but it'll soon need to raise the debt limit, lest the U.S. Treasury default on its debts. With Democrats completely in control of the nation's legislative and executive branches, Republicans are refusing to help. Should the economy slow and absent fresh economic stimulus, one Morgan Stanley analyst warns that stocks could drop 20%. The anxiety over what may come is driving much of the pessimism, but everyone should be prepared for the downfall. Investors should be especially cautious about their investments. Since the Evergrande crisis swept through global markets, the price of Bitcoin and Ethereum have dipped significantly. The concerns of a possible huge debt default in China sparked a wide market sell-off. Not only digital markets, but also traditional stock markets are being affected from the ongoing threat of failure of Chinese real estate giant. The spillover can have huge impact on markets in coming days, so look out. So that's all for today's video. Let us know your views in the comments section below, and don't forget to like this video before leaving. Thanks for watching.